when your investments or your debt and equity securities are reported on your balance sheet at the end of the period. Where you report them in a breakdown of your classified assets depends on what you are going to do with that investment. If you think it is more likely than not that you will not have that asset on your books for more than a year, you should report it as a current asset. If you think it's more likely than not you're going to have that asset on your books for a period of greater than a year, well, then you should report it as a long-term asset. So if something is trading debt, that means that you would sell it the first chance you had to make a profit on it, and hopefully it's more likely than not that you're going to do so within the next year. That would be a current asset. If you have held to maturity debt investments, that means you're planning on holding it until the mature life of that bond that you bought from another company reaches its end, which means in most cases that's going to be a long-term asset unless it matures within the next year, in which case if it's going to mature within the next year it would be a current asset. So that's governed by the maturity date of the investment that you have, and if it's available for sale, you have the option of putting it in current assets or putting it in long-term assets. Depending on which one of those situations you're going to hold it for more than a year or you're going to get rid of it within the next year is more likely. So there is something that GAAP allows for investments in other companies that you are allowed to do your books that you're not allowed to do for anything else, and that is adjusted to fair value. A fair value adjustment allows you to carry these assets on your books at what they are worth right now on the market instead of at your historical cost. However, to do so, you can't just increase the value of the asset you have to what it's trading for right now. GAAP requires you to take out a separate account which tracks the unrealized gain that you could experience if you sold it today on your books. And it's unrealized holding gain or unrealized holding loss depending on how the market price of that investment has changed since the time that you bought it. So over here, as we can see on this set of financials, this particular company has decided to throw their long-term investments into long-term, their short-term investments into short-term, and if they had any realized gains of a sale on any of their investments, they were reported on their income statement. Let's do some journal entries for this unrealized gain concept. So on December 31st, 2018, Smart Touch Learning is going to report trading debt investments of $26,160. That's what they have. That's the actual basis that they have that they paid to acquire this trading debt in the first place. However, they believe that the fair market value right now of that debt that they have invested in is only $24,000, which means they shouldn't really have an asset on their books saying that this investment they have is worth a little over $26,000 when they could only realize $24,000 from the sale of it today. And since it's trading debt and they're going to sell it whenever they get the chance, they should carry it at its fair value. So the difference between what it is on the books for and what its fair value is on the market is $2,160. To put that on the books, they are going to debit an account called unrealized holding loss dash whatever type of investment it is, in this case trading debt, for $2,160, and they're going to credit an account called fair value adjustment, again dash whatever type of asset it is, this case is trading debt, for that same $2,160. And those two numbers together create the fair market value of the asset. So you don't actually remove the investment from your books. You always keep it on your books at its historical cost, at its cost basis, for the entire time that you have it. But you have this account that is linked to it, which is a contra account or maybe an adjunct account if it's gone up, which adjusts its value to its fair value. So when we report this, we would say we have trading debt investments at a historical cost of $26,160, but we're fair value adjusting them down $2,160 to report their overall fair value of $24,000. And on the balance sheet, you have a couple of options. The option that Smart Touches chose to do here is to report it at its fair value. Well, if you do that, you also have to disclose within the balance sheet what its cost is. So in this case, you're saying trading debt investments of $24,000, reported at fair value with a cost basis of $26,160. If they wanted to, they could report two separate line items the same way that you would report your accumulated depreciation, or you would put trading debt investments at its cost less the value of its contra account, in this case your adjustment, to give you your carrying value, which would still be $24,000. Well, what happens to the other stuff? Well, the other stuff that you would throw in here, your unrealized holding loss or your unrealized holding gain, those are income statement accounts. They're related to revenues and expenses, essentially. They offset your income, which means you will report any unrealized holding losses that you had in your income statement for the period. So let's do some examples right here. We'll say on November 1st, McFly Motor Company purchases $100,000 worth of bonds in under the sea aquariums, and they intend to sell these bonds as soon as they can get a fair price for them on the market. They can make some kind of profit off of it. Well, that's trading debt. So, sorry about that. We would report it as trading debt investment at its cost basis of $100,000 and take the cash out of our account that we would use to acquire these by crediting cash for that same $100,000 in the entry where we purchased this trading debt investment. We purchased these bonds. Well, on December 31st, at the end of the year, we'd still be carrying these, but prices of investments are always going up and down. At the time that our fiscal period is ending, this investment that we have in under the sea aquariums has increased to $110,000. So we could sell this for a $10,000 profit right now. We haven't realized that profit yet, but it's unrealized, but we could, which means we need to make a adjustment to the fair value of this particular account. And what we're going to do is we're going to increase the amount that we have invested in here, or I should say the market value of the investment that we have here, by the difference, which is $10,000. The $110,000 it's currently going for on the market, less the $100,000 we paid for it. And we're going to debit this because the price is going up and it's tied to an asset. So if we also debit our associated account here, it increases its overall carrying value. If it was going down, we would need to credit it because assets go down on the credit side. And our credit in that entry is going to be our unrealized holding gain on our trading debt investment for the same $10,000 when we adjusted our trading debt to its market value. For available for sale debt investments, what we're going to do here is we're basically going to do the same exact concept that we did for trading debt investments. But we are going to use something which has a crazy name called AOCI, Accumulated Other Comprehensive Income. And essentially what that is instead of actually putting any gains on our statement, we're going to put it into a different account. And the reason for this is if we put it right on our income statement saying it's going to affect our income with the period. And if it was trading debt, it would, because we would sell it as soon as we possibly could. We're intent on selling this thing. If we're reporting it as available for sale, we don't know. Maybe we could, maybe we can't. And we can't manipulate our income based upon that if we're not hell-bent on selling this investment. So the journal entry to make your adjustment to the fair value is still the same. If Smart Touch Learning had AFS investments of $60,000 and the market value was $64,000, they need to increase that value on their books, and they would do so by debiting fair value adjustment of their available for sale investments for $4,000 and crediting their unrealized holding gain for $4,000. Those two accounts together, when you tie them to one another, have a total value of $64,000. So your carrying value of your available for sale debt investments at the time that this company would report on December 31st, 2018, would be at a value of $64,000. Your historical cost basis of $60,000 plus the $4,000 of adjustment that you made because the fair value of this investment has increased. The difference here when you report this is we can't report it as income because, like I said, it's not a guarantee that we're going to move this within the next year. So what do you do with the unrealized holding gain that you have on that? You put it into your equity section. So on your balance sheet, you would report your available for sale debt investments. They're using the same method here where they report it at carrying value, at its fair value, and then report its historical cost separately. So it's carrying at $64,000 with a historical cost of $60,000. And in your stockholders equity section, you would have a whole different section beyond your paid-in capital and beyond your retained earnings called your accumulated other comprehensive income, or AOCI, and we will report our unrealized holding gain on our available for sale debt investment there for the $4,000 instead of putting it on the income statement.